Yes, good day, my student. Today I want us to look on this topic of impairment of assets. And as far as this topic is concerned, we're going to look on a number of issues. One, we're going to define what is impairment of asset. Two, we look on how impairment of asset is recognized, or basically is measured in accordance with IS 36. Some of the factors which indicate that an asset could be impaired, and therefore requiring a company to carry out an impairment review. And then from there, we look on how we determine the impairment of the cash generating unit, and also how we go ahead and allocate that particular impairment loss to the various assets in such a cash generating unit. But to start with, I want us to start by defining the term impairment of asset. When talk about the impairment of asset, this refers to the fall or the reduction in the value of an asset such that the recoverable amount of an asset is now below the carrying amount. It is the reduction, it is the fall in the value of an asset such that its recoverable amount is now less than the carrying amount. Generally, an asset is said to be impaired if the recoverable amount of such an asset has reduced below the carrying amount. Basically, when we talk about the recoverable amount of an asset, this is the amount at which an asset or the entity can recover from the continued use of the asset, or basically from its disposal. So if that amount is less than its carrying amount, then such an asset is said to be what? To be impaired. So therefore, you can say that impairment is what? Is the reduction in the value of the asset, in the value of an asset such that its recoverable amount is now less than the carrying amount, the carrying amount. So therefore, it is very, very important here to note that an asset here will be said to be impaired if its value has reduced such that the recoverable amount of that particular asset now is deemed now to be less, than what is the carrying amount. So here we have some important terms which you need to understand. We have some important terms which you need to understand. One of the terms is what is the recoverable amount. And the other one is the carrying amount. But even before we define those particular two terms here, we say that an asset will only be said to be impaired if the recoverable amount of such an asset is less than the carrying amount, Now, what do we mean by these two terms here? The first term is the recoverable amount, and then we have the other term, which is what? Which is the carrying amount. So practically, I've said the recoverable amount is the amount which an entity can recover, one, from the continued use of the asset, or number two, from its disposal. Generally, what we know is that once a company has acquired an asset, the company incurs some cost. So how can the company recover that cost? There are two ways in terms of how the cost may be recovered. One, the company may decide to sell that asset, or the company may sell that asset and recover the cost which was incurred, or the company can use that asset, and because the company using the asset, the company generates some cash flow. The company now will recover the cost from the cash flows which will be generated from the continued use of that asset. And therefore, in terms of how we define this particular term here at the IS 36, we say that a recoverable amount is the higher, or this is defined to be the higher of two values. One, the net realizable value. The net realizable value, in other terms, is the fair value less cost to sell, less cost to sell. So this is the amount at which now an asset can be sold at currently, and then we deduct the cost which will be incurred in selling that asset, because what we know is that if the company intends to sell an asset, maybe the company will need to, for example, to place an advert in the newspaper so that the company can be able to get a buyer, or the company, for example, will need to incur some repair costs, will need to repair that particular asset in order to get who? To get now a buyer. So that cost, which will be incurred in order to sell the asset, we refer to it as the cost to sell. So we take the HAR of that, net realizable value, or the fair value less cost to sell, and the value in use. The value in use. What is the value in use of an asset? The value in use is the present value of the expected cash flows to be generated from the use of the asset, and its disposal So generally what you have said is that if an entity owns an asset, as a result of using that particular asset, the entity generates some cash flow. So to get the value in use here, what we do is that we discount such cash flows. We get the present value of the expected cash flows to be generated from the use of the asset, and also its disposal. So therefore, to determine this particular value, which we are referring to as the recoverable amount, we take the HAR of those two values. Now the other term which we also have here is the carrying amount. Now, what is the carrying amount? When we talk about the carrying amount of an asset, this is the amount, or basically this is the value, at which an asset is stated or is recorded in the company's statement of financial position. So we can say that this is the value of an asset in the statement of financial position. In other terms, the carrying amount here is the net book value, of an asset. And generally what we know is that the net book value of an asset is determined by taking the cost minus the accumulated depreciation. So therefore, it is important for you to be able to understand those two terms. And therefore, what you have said is that according to IAS 36, an asset is only said to be impaired if now the value of an asset has reduced, and now the recoverable amount of an asset is found to be less than the carrying amount. We remember you have said that the recoverable amount is basically the amount the company can recover from selling the asset or from continuously using that particular asset. So if this is less than that, then the asset is said to be impaired. If the asset is said to be impaired, what the entity should do is to proceed and determine something called the impairment loss. And this impairment loss is determined by taking the carrying amount, minus the recoverable amount, So that what IAS 36 requires the company to determine now the impairment loss. And then, other than determining this particular impairment loss, the entity is also required to do what? To reduce the value of an asset, or basically to reduce what? To reduce the carrying amount of an asset. Reduce a carrying amount of an asset to its recoverable amount. Anytime the asset is found to be impaired, two things should happen. One, the company to determine now the impairment loss, and two, to reduce that particular amount at which the asset is already recorded in the statement of financial position to an amount equal to the recoverable amount, an amount equal to the recoverable amount. But it is also important to note that this particular standard here, IS-36, it requires an entity or a company to carry out an impairment review at the end of each financial year if there exists a factor, if there exists some evidence which shows that the asset could be impaired. Now here we have a number of factors, or basically we have various evidence which could show that the asset could be what? Could be impaired. So I think we can look on those now indicators of impairment, indicators of impairment, indicators of impairment. So when talk about the indicators of impairment, we have said that these are factors which then shows that an asset could be impaired, of which you have said that if any of these particular factor exists, then what an entity should do is basically to proceed and carry out impairment review. Basically, carrying out impairment review entails comparing the two values here, the recoverable amount of an asset and the carrying amount. And basically, the entity should check whether the recoverable amount is now less than the carrying amount. If that is the case, then you have said that the entity should do those two things. One, determine the impairment loss, and two, reduce the carrying amount of an asset to its recoverable amount. Now, these particular factors or these indicators of impairment generally are classified into two. One, we have what refer as the internal indicators. So when talk about internal indicators, basically we can say that these are indicators of impairment, basically which are within the control of the entity, which are within the control of the entity. So which are some of these internal indicators which shows that the asset could be impaired? One is what refer as the obsolescence of an asset, or physical damage of an asset, physical damage of an asset. In this case, when talk about the obsolescence of the asset, and this whereby the asset is no longer needed by the company. Maybe the asset, or for example, the company own a machine, but the machine is deemed to be too small. It cannot be used by the company, maybe because the company has increased the production. The company need to acquire maybe a bigger machine. So all two, if an asset is damaged, for instance, if a company owns a motor vehicle, that motor vehicle is involved in an accident, it is damaged. That is one of the internal factor which indicate that the asset could be could be impaired. Number two is the asset becoming idle. Asset becoming idle. When talk about the asset becoming idle, basically this means that the asset is no longer needed by by the company. That is the other factor which basically indicate or shows that the asset could be could be impaired. Number two is where the performance of the asset, performance of an asset, being worse than expected, So this whereby the performance of the machine is lower than what was initially anticipated, or basically worse than what was initially expected by the entity when the entity was acquiring that particular asset. And number four, the other point is the plan to discontinue. Plan to discontinue the operation, which the asset belong, So when talk about the plan to discontinue the operation, this whereby the company intend to stop the operation, to which the asset belong. For instance, maybe we assume that the company produce a number of products, product A, product B, product C, and the company intend to stop producing product C. So it automatically means that the machines now which are used, the assets which are used in terms of producing product C will be deemed to be impaired, because by the end of the day, the company may sell them at a throwaway price. So therefore, all these are the internal indicators or the internal factors which shows that the asset could be impaired. And therefore, what you have said is that according to IAS 36, anytime such a factor exists, or maybe there is evidence to show that the asset could be impaired, then the entity should automatically proceed and carry out the impairment review. Impairment review, we have said, is a process of comparing two values, the recoverable amount of an asset and the carrying amount. And if the recoverable amount is found to be less than the carrying amount, then you have said that the entity should proceed and recognize or determine the impairment loss. Then from there, we have the external indicators of impairment. So external indicators of impairment, generally, we can say that these are factors which shows that the asset could be impaired. But basically, these factors are not within the control of the entity, are not within the control of the entity. So which are those external indicators of impairment? One is what you refer as the increase. Number one is the increase in market interest rate, market interest rate, which affect the discount rate, or affecting the discount rate, affecting the discount rate, and thus reducing the value of the asset, So if the market interest rate has increased, so that is a factor which could show that the asset may be impaired. Number two is observable evidence. Observable evidence, or basically observable indication that the asset value has done what? Has declined during the period significantly more than what was expected. So mean that if there is some observable evidence, if there is some evidence the entity can be able to see, which shows that the value of the asset has significantly reduced during the current financial year than what was expected, then that is also a factor which basically indicates that the asset could be impaired. The other factor is where we have some adverse changes. Some adverse changes, or basically we can talk of significant changes. Significant changes with some adverse effect, on the entities, technological, economic, and the legal environment. So basically, these are some of the factors which basically indicate or may provide some evidence that the asset could be impaired. And we have said is a requirement that if there exists such an indicator, or maybe if there exists some evidence which shows that the asset could be impaired, it is obvious that the entity will have to proceed and carry out the impairment review at the end of the year. Compare the recoverable amount of the asset and the carrying amount. If the recoverable amount is found to be less than the carrying amount, the entity proceed, determine the impairment loss, and 2, be able to or reduce the value of the asset to an amount equal to the recoverable amount. Now, how do we then proceed to account for this impairment loss? So I think we can look on the accounting treatment. Accounting treatment of impairment loss. Impairment loss. Now, in terms of how we account for this impairment loss, it depends with how, or it depends with the value at which an asset is recorded in the statement of financial position. One, we have those particular assets which in the statement of financial position are recorded at their historical cost. So these are those particular assets, since they were acquired by the company, they have not been revalued. There is no revaluation loss, revaluation reserve which exists as far as such an asset is concerned. And 2, we have those particular assets which in the statement of financial position, they are carried, they are recorded there at their revalued amount. These are those particular assets which, since they were acquired by the entity, they have been revalued. So there exists a revaluation reserve as far as that, such asset is concerned. Now, one, we can look on how we account for impairment loss for assets carried at historical cost, cost. So in this case, when we talk about the assets which are carried at historical cost, these are those particular assets which in the company statement of financial position, they are recorded there at historical cost. Generally, we have said that these are those particular assets, since they were acquired by the entity, they have not been revalued. So first of all, or basically as far as these particular assets are concerned, any amount of impairment loss, in respect to this asset is recognized as an expense in the income statement. The full amount of impairment loss is recognized as an expense in the income statement. In the income statement. How do we, or what are the accounting entries? The accounting entries for such impairment loss, are as follows. 1, we debit the income statement. So by debiting the income statement means that this amount of impairment loss, we treat it as an expense in the income statement. And it is obvious, or here, it is important to mention that these impairment loss should be classified as part of the administrative expenses. And 2, what we do is that we credit the specific asset account. Why do we credit the specific asset account? Remember what I've said here is that once an asset is impaired, we have said that we need to reduce its carrying amount to an amount equal to the recoverable amount. So that's why we are crediting the asset account to reduce the carrying amount of the asset to an amount equal to the recoverable amount. So that's how we account for impairment loss for those assets which are carried at their historical cost. 2, we can look on how we account for impairment loss for assets which are carried at revalued amount. So when we talk about the assets which are carried at revalued amount, so these those particular assets, since they were acquired by the entity, they have been revalued. So, and what we know is that once an asset has been revalued, that revaluation gain is basically credited in an account called the revaluation reserve. So therefore, first of all, we say that an amount of impairment loss, equal to the revaluation reserve, should be charged in the revaluation reserve account, reserve account, and any excess impairment loss, should now be charged in the income statement. Should be charged in the income statement. Should be charged in the income statement. The income statement. So for you to be able to understand what you mean by that, maybe you can have a very small illustration here. We assume that we are told that an asset is impaired. We have determined, or an entity has determined, the impairment loss of an asset using the approach which I explained earlier on here. And you're told that the asset is impaired with an amount of 3 million. And we assume that this particular asset was revalued some time back, and a revaluation reserve exists in respect to this particular asset, a revaluation reserve of 2 million. So mean that the asset had been revalued some time back. In the statement of financial position, there is a revaluation reserve of 2 million, and the asset now has been deemed to be impaired, or is deemed to be impaired with an amount of what? With an amount of 3 million. Now, a question arises: how do we then go about, or how do we account for this impairment loss? So first of all, we have said an impairment loss, which is equal to the revaluation reserve. Now, our impairment loss here is 3 million. So meaning that the impairment loss which is equal to this is an amount of 2 million. So this one we are saying it should be what? Charged in the revaluation reserve account. This is what you are saying we should charge in which account? In the revaluation reserve. And then the excess impairment loss. What is the excess impairment loss here? The excess impairment loss is the amount of impairment loss which is more than the revaluation reserve, which is 1 million. And basically now that is the amount we are saying that should be charged in the income statement. So therefore, how do we then account for this amount of impairment loss? How do we account for it? The accounting entries will be as follows. The accounting entries will be what? Will be as follows here. 1, we are going to debit the revaluation reserve account with this amount of impairment loss 2 million. Then the excess impairment loss, which is 1 million. We are saying that this is what we take to the income statement as an expense. As an expense, 1 million. And then the full amount of impairment loss should be credited in the specific asset account. Specific asset account, the amount of 3 million, with an objective of reducing now the carrying amount of an asset to an amount equal to the recoverable amount. So that's how we account for impairment loss. Impairment loss therefore should be accounted for, or in terms of how we account for this impairment loss will depend with whether the asset is carried at historical cost or at revalued amount. At revalued what? Amount. Now, that basically what you need to know as far as the determination of impairment loss is what is concerned. Now, with that, I want us to proceed and look on an illustration question from the paper for Advanced Financial Reporting, November 2022. We have question number 1C. That is the question I want us to do. It was testing, or it was from this topic of what? Of impairment. So I've said the question is November of 2020, not 2022, and this is question number 1C. So first of all, I want us to go through that question so that we can understand how we determine the impairment loss of an asset. So what we are told in that question, or the question reads: ABC Limited own a machine which originally cost 10 million. The accumulated depreciation associated with the machine was 2.5 million as at 31st December 2019. A mechanical engineer assessed the machine early in January 2020, the engineer's report stated that a similar damaged machine had sold for shillings 1 million in the recent past. In addition, due to the machine unique nature, a significant advertising cost of shillings 100,000 would be incurred to find a seller. So this is now what he has the cost to sell. For the company to be able to get now a buyer of the machine, the company need to advertise it at a cost of 100,000. So we are told that the machine was not covered by the insurance. And then you are told a power surge. This is a problem with the power or during the year ended 31st December 2019, reduced the machine production capacity and shortened its expected life. So that is an evidence which shows that this machine could be impaired. Remember what you have said is that once the performance of an asset is worse than what was initially expected or initially anticipated, then that is an evidence which shows that an asset could be impaired. And therefore, because there exists a factor of, or there exists an indicator of impairment, it is then a requirement at the IS 36 that at the end of the year 2019, the company must carry out the impairment review. So then you are told 𝗵𝐶 Limited management accountant estimated that the damaged machine would generate cash flows of shillings 3 million per annum over an expected remaining life of 3 years. So this is for determining the value in use. And then you're told 𝗵𝐶 Limited cost of capital is 9%. And then you're told no impairment of the machine has been recorded in the account. What are we required? We are told in context of IS 36, which deals with the impairment of asset, outline the necessary accounting treatment of the machine given the above information. Then you are told note the present value interest factor of annuity is shillings 1 per year at 9% for 3 years is 2.5313. And that question was having how many marks? Was having 4 marks. So in this question here, generally you can see the examiner was not requiring you to compute now the impairment loss, but what you're required to do is you train the accounting treatment of the machine. So the first thing you are supposed to say here is that at the end of 2019, because there exists some evidence of impairment, this entity, according to IS 36, should go ahead and carry out impairment review. And basically, after doing that, you show how the impairment review was supposed to be done, whereby you have said impairment review will entail the entity comparing two values, carrying amount and the recoverable amount, and determine whether the asset is impaired or not. If it is impaired whereby the recoverable amount is less than the carrying amount, it is obvious the entity should go ahead and do what? Determine the impairment loss. So therefore, what we are supposed to say is that the 𝗵𝐶 Limited, we are supposed to say that 𝗵𝐶 Limited must carry out impairment review on 31st of December 2019, since there exists some evidence of impairment. So which is that evidence of impairment? The evidence of impairment, you are told this machine, or there was a power surge, there was a problem with the power at the end of 2019, which damaged this machine. And as a result of that, its expected life was shortened, and also that reduced the performance of the machine, or the production capacity of the machine. That's why we are saying the entity should carry out the impairment review at the end of 2019. So we have said that carrying out impairment review here will entail the entity comparing two values, the recoverable amount of the asset. This will be compared with what? This will be compared with the carrying amount. And if this is found to be less the recoverable amount is found to be less than this one, then we have said that the asset is said to be impaired. So most of the question will ask, if now this is not less than that, in such a case we say that the asset is not impaired, nothing will happen. So we only account for impairment loss if the recoverable amount is less than what? Carrying amount. So I think we need to determine these two values. So let's first of all start by determining the carrying amount. Remember, you have said that the carrying amount, this is the amount at which now an asset is recorded in the company's statement of financial position. In other terms, you have said that this is the same with the net book value. And when are we determining this net book value? We are determining this net book value on 31st of December 2019, when that evidence existed and which showed that the asset could be what? Could be impaired. So to determine this net book value is very, very simple. We take the cost minus the accumulated depreciation minus the accumulated depreciation. So do we have this information? Yes. In the first paragraph, we are told that the cost of the machine was 10 million. And then we are told at the end of 2019, its accumulated depreciation was 2.5 million. So meaning that its carrying amount at the end of 2019 was what? Was 7.5. So meaning that in our case, we already have what? We already have the carrying amount there. So then let's proceed and we determine the recoverable amount. We determine the recoverable amount. So how do we determine this recoverable amount? Recoverable amount, we have said that this is determined to be the higher of two values, is determined as the higher of two values. So we say that this is the higher of two values. One, what refers the net realizable value. Net realizable value, you have said, is the fair value less cost to sell. So this is the amount at which the asset can be sold at currently minus the cost which will be incurred to sell that asset. Now we're given some information under the first paragraph, where we are told, first paragraph sentence 3, we are told a mechanical engineer assessed the machine in early January, January here, and we are told the report by that engineer showed that a similar damaged machine, remember our machine here is already damaged, it was damaged due to that power surge. A similar machine could be sold for 1 million. And then you're told somewhere there in the last paragraph that due to the unique nature of the machine, to sell that machine, the company need to place an advert in the newspaper to be able to get a buyer. That advert will cost the company how much? 100,000. This 100,000 is the cost which will be incurred by the company to sell, is the cost to sell. So therefore, currently the asset can be sold at 1 million. That is now what refers as the fair value here. And to sell that machine, the company will incur a cost of 100,000. So meaning that the net realizable value here, the net realizable value or the fair value less cost to sell is what? Is 900,000. Now having that, we need to proceed and we do what? We determine the other value, because you have said this recoverable amount is the higher law, and this net realizable value or number two, what refers the value in use. The value in use, this one we have said is the present value of the expected cash flows. Present value of expected what? A cash flow. So that's how we determine the recoverable amount. Now there is some information which are given here in paragraph 2, sentence 2, where we are told ABC management accountant estimates that a damaged machine could generate cash flows of what? 3 million. So meaning that the expected cash flows here to be generated is 3 million per annum, 3 million per annum of the expected remaining life of 3 years. So therefore, how do we, because we are told this damaged machine is expected to be used for the next 3 years, and per annum, it will generate a cash flow of 3 million. So these cash flows are annuity. We need to discount that. So therefore, to discount this, we need to multiply this with something called the present value interest factor of annuity, at which rate? At the rate of 9%, at the rate of 9% for 3 years. And we already given this particular value here. After the requirement, there is somewhere we are given a note whereby we are told the present value interest factor of annuity of sharing 1 at 9% for 3 years is 2.5313. So this figure is already given to us. So therefore, what we do is that we take 3 million times this figure here, which is given as 2.313, 2.53113. So what we need to do in our case is basically to multiply the two values so that we get that final figure. So let's multiply this. We have 3 million times 2.5313. So this will give us 75,93,900. So what is this now? This is the value in use. So therefore, the recoverable amount, we take the higher of that 900,000 and this one, and automatically the figure which is higher is that one. So therefore, you can say that the recoverable amount here, that the recoverable amount of our asset is what? Is shilling 75,93,900. So we already have now the two values which we need. We have the recoverable amount, which is this one. And then do we have the carrying amount? Yes, we have the carrying amount here. So what we need to do is now to determine whether our asset is impaired or not by comparing the two values. The recoverable amount, which is what? 75,93,900. We compare that with the carrying amount. We can just use CA, carrying amount, which is this figure here, 7.5 million. 7.5 million. So what we need to do is to check whether our recoverable amount, this one, is less than the carrying amount. Is this figure less than that one? Is this less than that one? No. So the recoverable amount is not less. This figure is not less than that. So what does that mean? It means that this machine is not impaired. So that is the answer here. We say the machine is not impaired, since the recoverable amount, is not less than carrying amount, CA, than carrying amount, thus no impairment loss. Thus no impairment loss to be recognized. Thus no impairment loss to be what? To be recognized. Thus no impairment loss to be what? To be recognized. Yes. So that is it. That what was required in that particular question here. As far as the determination of what? Of impairment loss is what is concerned. So therefore, it is important to note that according to IAS 36, an entity should carry out impairment review at the end of the year if there exists a factor or indicator which shows that the asset could be what? Could be impaired, of which we have said that entails the entity comparing two values, the recoverable amount and the carrying amount. And we have said that if the recoverable amount is found to be less than the carrying amount, the asset will be said to be or will be deemed to be impaired, and therefore the entity should proceed and do what? Determine the impairment loss. So that is all about that particular illustration questions here. So we stop at that particular point. So once we meet in our next video, we are going to look on how we determine the impairment loss of the cash generating unit, and how we proceed and allocate the impairment loss of the cash generating unit to the various assets in such a unit. But for now, we stop at that point.